Thank you very much. And it is indeed a great pleasure for me to be here this evening with you in this university environment that I miss, at least since 2010, when I had to give up teaching classes that I continued to do while I was at that time governor of the Central Bank of Portugal before moving to Frankfurt to the ECB. So it's indeed a great pleasure. And to talk with you about current and potential challenges which our economies with their ever-evolving financial systems are facing at present and will likely be facing in the future. So the final title of my talk is Financial Stability Risks, Monetary Policy, and the Need for Macro-prudential Policy. Indeed, to safeguard financial stability, it is necessary a new set of policy tools that are under the umbrella of the macro-prudential nature. The financial crisis has changed our understanding of the interactions between the economy and the financial system, and the risks which these interactions may bring about. In fact, the crisis did not only require a major policy response in order to contain the damage done to our societies, it has also triggered a redesign of our policy framework to safeguard financial stability in the future. The financial crisis generated a big recession and had enormous costs in terms of lost output and unemployment. In 2008, that led many observers and analysts and economists to think that deep reforms of the international monetary and financial governance would follow the acknowledged failure of the financial regulation in place. Two well-known specialists in the field, Barry Eichengreen and Eric Elliner, have very recently published two books explaining why a transformative reform of the international system has indeed not occurred. Eichengreen explains it in the following way. Depression and financial collapse were avoided, if barely. This fostered the belief that the flaws of prevailing system were less than thought. It weakened the argument for more radical action. Success thus became the mother of failure. End of quote. Well, this sounds too harsh, because I think that good work has been done in adopting measures in the domains of capital ratios, liquidity, and resolution of banks in order to increase the resilience of that important component of the financial system. However, much less has been achieved in what regards over-the-counter derivatives or non-bank entities, including activities of the shadow banking. Also, no significant changes were introduced in the international monetary system as such, and the G20 and the Financial Stability Board do not have the full powers to fulfill the role of the so-called fourth pillar of international economic governance, contrary to what was initially announced by the US Treasury Secretary Tim Geithner. As remarked by Elliner in his book, a promising innovation, nevertheless, that emerged from the crisis is the macro-prudential policy as a new area that uses regulatory measures to deal with system-wide financial risk. Systemic risk refers to the risk that financial instability becomes so widespread that it impairs the functioning of a financial system to the point where economic growth and welfare suffer materially. Systemic risk may originate from three types of sources. First, significant macroeconomic shocks that can make the financial sector vulnerable. Second, the contagion that may stem from default or of a few financial institutions as a result of the growing interconnectedness existent within the system. And finally, the development of endogenous financial imbalances associated with credit booms, excessive leverage, and risk-taking by financial institutions. The crisis has taught us that an apparent good capital and liquidity position at the level of individual institutions, as monitored by micro-supervision, does not guarantee the stability of the system as a whole. In this context, macro-prudential policy has two main objectives: to enhance the resilience of the whole system and to smoothen the financial cycle, meaning the fluctuations of credit, leverage, and asset prices that many times lead to boom-bust episodes. The instruments available for macro-prudential policy include, of course, most of the micro-supervision instruments related to capital or liquidity. When applied, of course, to the system as a whole, but extend to other categories of measures like limits to loan-to-value ratios in housing credit, general counter-cyclical capital buffers, global leverage ratios, or haircuts and margin requirements in securities transactions or clearing activities. The financial cycle, which is a sort of update of the old concept of the credit cycle, tends to have larger amplitude than the normal business cycle, meaning that the fluctuations of credit, leverage, and fundamental asset prices represent the financial cycle, and the business cycle is, of course, refers to the fluctuations of real economic activity measured by GDP. And it is now identified that the amplitude of the financial cycle tends to be much larger than the fluctuations of real economic activity, implying that long periods of disconnect between the two cycles can materialize. Traditionally, this separation between the two was not considered very likely. In particular, it was thought that price stability in the market of goods and services would be sufficient to guarantee financial stability in the market for assets. The present situation and the period of the so-called great moderation ahead of the crisis should be sufficient proof to dispel such traditional beliefs. Before the crisis, while inflation was low and stable, significant financial imbalances were building up as the relatively deregulated financial system engineered a credit boom and a highly risky leverage situation. The present moment is characterized by very low inflation and subdued growth, accompanied, nevertheless, by some froth in financial asset markets resulting from search for yield in an environment of low interest rates. This disconnect between the financial and the business cycle creates a dilemma to traditional macroeconomic policy and especially to monetary policy. The main remit of monetary policy refers to the relevant variables of the business cycle: GDP, real economic activity, and inflation in the market of goods and services. The consideration about the fluctuations of real economic activity enters directly in the case the central bank has a dual mandate, like in the WES, related to inflation and growth, or indirectly in the case of a hierarchical mandate like the one of the ECB. where the level of economic slack in the economy is one of the drivers of inflationary or deflationary pressures. The more common monetary policy framework around the world is still the inflation targeting regime, where there is no role for any target related to asset prices. More generally, no central bank has in its mandate objectives explicitly referred to asset prices. It is true that after the crisis, there has been a trend, albeit without legislative expression, to attribute a goal of financial stability to the central bank's remit. Nevertheless, in order to be justified, the central banks would have to be entrusted with a new set of tools of a macro-prudential nature that can be applied to the financial system as a whole in order to fulfill such dual mandate. There are two reasons why monetary policy as such cannot and should not be normally used to deal with financial instability in asset markets. The first type relates to the fact that the priority goals of monetary policy may require an expansionary stance when asset markets would require restrictive measures or the other way around. Monetary policy cannot abandon its priorities as they are clearly stated in the legal mandates of central banks. More generally, as Mervyn King once stated, it would be highly controversial if a restrictive central bank policy adopted for reasons of asset market risks would create mini recessions in real activity and unemployment when the level of inflation would be compliant with the defined and publicly known target. We have some examples of this thing happening. The second argument questions whether monetary policy, through its main instrument, short-term interest rates, can effectively target asset market prices. There is no theory or economic model establishing a reliable relationship between interest rates and asset price targets. So macro-prudential policy is therefore essential in any economy as the business and financial cycle are not synchronized. Even more so in a monetary union, where vulnerabilities identified in each country can be addressed with macro-prudential policy, allowing for the appropriate heterogeneous situation while countries remain subject to a single monetary policy. Monetary policy affects all sectors of the economy at the same time and can therefore be an ineffective tool to cope with specific imbalances in the financial sector in some members of the monetary union. Finally, by independently addressing financial stability concerns, macro-prudential policy provides monetary policy with additional room for maneuver to better focus on ensuring price stability. Take the present moment. The search for yield continues in global financial markets. Flows to high-yield bonds and emerging market funds turned positive in January after recording significant outflows in the second half of 2014. Credit spreads have narrowed. At the same time, issuance of European leveraged financial products, high-yield bonds and leveraged loans, has surpassed pre-crisis levels. Issuance of leveraged loans has reached a 7-year high in the fourth quarter of 2014. Furthermore, a growing correlation of asset price movements across market segments is reducing the investor's ability to hedge via portfolio diversification. Nevertheless, it should be noted that the situation of froth in asset markets is less marked in Europe and in the euro area in particular than in other parts of the world. For instance, stock prices reflect the historic level of price-earning ratios, whereas in other parts of the world, these price-earnings ratios are well above any historical averages. And model-based valuation of normal corporate bonds, not high yield, do not show indications of overvaluation. Nevertheless, in such a situation, monetary policy needs to stabilize prices and continue to support real activity, while macro-prudential policy needs to tame the financial sector in asset market segments showing signs of exuberance, like in some countries, real estate and housing, in other parts, financial assets. Monetary and macro-prudential policies are thus two different sets of tools that sometimes have to adopt different stances, whereas in some other situations may share common goals. In any case, there are important synergies and interactions and need for coordination between the two policy functions. This also supports the rationale for placing the macro-prudential policy function under the responsibility of central banks, as reflected in the macro-prudential policy framework adopted for the ECB and for the Bank of England and for the Fed. The movement has been worldwide. Monetary policy must prioritize the goal of price stability and cannot deal with the emergent financial stability issues. The treaty in Europe does not even mention stability in asset prices as being included in the ECB's mandate. The separation principle implies that both fiscal dominance as well as financial stability dominance of monetary policy should be avoided by the central bank. This conceptual view was behind the recent ECB decision to increase the expansionary stance of monetary policy, not yielding to the voices that claim that we should consider first the risks for asset prices and for the risk-taking transmission channel of monetary policy. In order to tackle the threat to price stability created by a long period of very low inflation, which is contradictory to our mandate, we decided to enlarge the scope of our program of outright purchases of assets to sovereign bonds. In the present situation, the additional stimulus that we provide thus to aggregate demand will also help to reduce the negative output and unemployment gaps. The transmission channels of a large-scale asset purchase program include signaling and influencing inflation expectations, exploring spillovers resulting from investors using the cash received to buy other assets, and finally, the freeing up of space in banks' balance sheets to increase credit to the real economy. Therefore, the counter-argument that the policy would not be effective on account of the already low sovereign yields is not well-founded. The transmission goes well beyond the direct effect on the yields of the purchased securities. Even less valid is the argument that sovereign bond purchases would ease the pressure on governments to do structural reforms. It is not the task of a central bank to exert more or less pressure on governments to adopt policies for which they are responsible. They should implement the reforms that are necessary. In order for central banks to deserve their independence, they have to fulfill their responsibility to ensure price stability in the medium term, an objective that monetary policy has the power to achieve. To be credible, central banks must act in a symmetric way, avoiding both too high or too low inflation. As mentioned, monetary policy cannot cope with two different objectives at the same time. And the need for macro-prudential policy has become even more acute with the realization that advanced economies are very likely facing a prolonged period of low real and nominal growth. In such an environment, monetary policy has to remain accommodative with low interest rates, which unavoidably fosters search for yield and froth in asset markets, making the use of macro-prudential policy to tame the financial cycle and preempt asset bubbles even more necessary. The trend for lower GDP growth and productivity growth and for ever lower real interest rates has been going on for decades. For instance, the US annual productivity growth was 2.3% from 1890 to 1972, a long period of time with a significant annual growth rate. But then declined to 1.67 from 72 to 2004 and to 1.3 from 2004 to 2013. And this sort of evolution, we can see it in other parts of the world. I used US figures because this development cannot be explained by the absence of structural reforms, as it is often explained by economists in relation to other countries. On the contrary, the US normally is used as the benchmark as the more liberalized and lightly regulated advanced economy. To try to explain those that development, that trend, Robert Gordon, an American economist, in two well-known papers, has attributed that evolution to the slowing down and lower economic traction of technological innovation. On the other hand, we have seen that 10-year sovereign interest rates, taking long-term interest rates, in real terms, came down globally on average from 5 percentage points during the period 1980 to 1990, 10 years, to 3.2 in the following decade, from 91 to 2000, to 1.8 from 2001 to 2007, and to 0.4 in 2008 to 2013. This reflects then a worldwide tendency for planned savings to exceed planned investment, which then depends on a host of other factors, from demographics to differential riskiness of equities and bonds or real investment opportunities. This extreme view of these trends correspond the extreme view of these trends correspond to what has been called the secular stagnation hypothesis that would now cloud the future of advanced economies, particularly Europe. This hypothesis has two versions. One more related to the supply side, stressing technological and demographic factors behind the growth slowdown, and the other underlying the demand side related to excess savings and lower investment prospects. The extreme view of this demand side version points to the possibility that the real interest rate, thank you, that's great. The extreme view of this demand-side version points to the possibility that the real interest rates that would be the equilibrium rate at full employment could turn negative during long periods of time. These negative real rates could not be engineered or attained by monetary policy in view of the zero lower bound of nominal rates, leading monetary policy to use large-scale asset purchase programs or other ways of achieving an expansionary monetary policy. But even disregarding the extreme situations I just mentioned, it should be acknowledged that the monetary regime that became necessary practically in all advanced countries, consisting of low interest rates and large asset purchases, can indeed originate froth in asset markets, making it essential to find other instruments like macro-prudential policy to safeguard financial stability. Without the effective use of macro-prudential policy, advanced economies would face instability, asset bubbles, and further financial crises. It is more crucial. It is crucial to preempt financial cycle booms than to adopt a passive policy of just, as it is normally said, mopping up with liquidity provision the aftermath of crises, because we have learned how disastrous they can be. There is in some quarters skepticism about the possible effectiveness of macro-prudential policy. This skepticism may be related to a reluctance to accept the idea that a set of regulatory and administrative measures that interfere with the free function of financial markets became necessary to tame the excesses of finance. Once again, the crisis convincingly showed that finance cannot be self-regulated, and its frequent endogenous imbalances can be very disruptive of the real economy and the livelihood of millions. In reality, there is no alternative to making macro-prudential policy work effectively. And for that purpose, it needs to be applied in a timely, bold, and intrusive manner, affecting the normal behavior of financial markets or financial institutions. This brings about some big challenges. First, the policy has to be intrusive, which can take the form of imposing, for instance, caps to loan-to-value or debt-to-income ratios in credit to housing, or regulating haircuts and margins in securities transactions, or introducing limits to large exposures to specific sectors, or prohibiting proprietary trading to commercial banks or other types of structural restrictions. One can easily see how this type of policies would confront doctrinal refusal or reluctance. However, without them, simple measures related to capital charges may indeed not be effective to contain the boom phase of the financial cycle, because in that phase, the increase in the price of assets, take housing, can be so significant that any increase of certain basis points in the capital cost for banks will not be enough to offset the capital gains coming from the big increase in asset markets. Without other type of measures, macro-prudential policy cannot, indeed, in such situations, be effective. The second reason is that the macro-prudential toolkit, or the second issue related to this, is that the macro-prudential toolkit that has been legislated in most countries, in particular in the case of the European Union, which was entrusted to the ECB for the SSM countries, is not complete because it is mostly centered on banks and excludes other activities and institutions, namely the so-called shadow banking. With the more regulated banking system, the risks that regulation is circumvented by shifting activity to the unregulated sector are increasing. It is even more important since the size of this new market-based credit system has been growing almost uninterrupted throughout the crisis, at least partially compensating for the reduction of the credit from traditional banks. According to the ECB Banking Structures report, published last October, the size of the shadow banking sector in the EU more than doubled over the past decade. And more recent data show that for last year, the total assets of this sector in the euro area amounted to 23 trillion in mid-2014, from 19 trillion at the end of 2013, against 30 trillion for the total assets of the banking sector. And in the US, the size of the so-called shadow banking or non-bank market institutions involved in credit intermediation is indeed much bigger than the banking sector. From a financial stability perspective, a raise of the shadow banking sector may create systemic risks that need to be better understood and measured. This development, in part, is beneficial because it creates other sources of finance, but indeed, new risks may emerge. The sector is engaged in maturity transformation, the same way as banks are. Shadow banks do not hold deposits and are mostly funded via equity, because the biggest part of the shadow banking sector are investment funds of all sorts and nature. However, they are subject to the short-term redemption risk. If for any reason shadow banks experience substantial redemptions, they may be forced to promptly sell assets to fulfill their obligations, which may rise to fire sales and collapse of prices. This is particularly worrisome since 98% of almost 95,000 non-money market investment funds operating in the euro area alone in 2014 are open-ended funds, which means that the investors can redeem their shares in the funds in the short run, almost at any time. Moreover, the fund's buffer of liquid assets that can absorb the equivalent of a run on shadow banks has dropped in recent years, increasing the illiquidity risks. It is important to protect the border between shadow and non-shadow banks, which implies that a macro-prudential regulator could introduce large exposure limits on exposures of regulated institutions to shadow banks. Similarly, we could introduce margin requirements for repo transactions with shadow banks. These are non-direct instruments and may not be efficient in addressing the risks emerging in the shadow banking sector by themselves, but they are certainly important, and they have not been legislated in this specific way I just mentioned. The US Fed, on the other hand, has gained the competence to transfer non-bank financial institutions that can be systemic important to the supervised perimeter under the Fed. We do not have this powerful tool implemented in Europe. And in the US, they have already used this power to transfer to some sort of supervision by the Fed institutions like asset managers or big insurance companies. Certainly, some shadow banks grew too big to fail, and hence they should be subject to the same surveillance as global systemically important banks. In fact, the Financial Stability Board that works for the G20 is preparing a methodology for identifying global systemically important non-bank financial institutions. Another possible macro-prudential tool to address excessive leverage in conducting securities funding transactions, in conducting securities funding transactions and not centrally cleared over-the-counter transactions would be to introduce margin requirements for these transactions. Shadow banks could in principle be subject to direct regulations. In this context, cash buffer requirements and redemption fees or gates have already been discussed by expert groups and cannot be excluded. Finally, in order to mitigate the risk of regulatory linkages, any macro-prudential instrument operating via the demand for loans, such as loan-to-value or debt-to-income ratios, should be imposed at the borrower level, possibly by introducing restrictions in the consumer protection legislation and not via the bank regulations. This would allow for the extension of the perimeter of these macro-prudential instruments to beyond the regulated banking sector, because as we see now, non-bank institutions, including some insurance companies, are involved in mortgages and housing credit. So it's not only banks that need to have these loan-to-value ratios in some situations when the froth and the increase in housing prices starts to become dangerous. Let me conclude. Macroprudential policies are key to cope with systemic risk and endogenous cycles in the financial sector. They are particularly important in the euro area at the current juncture, as the global environment of low interest rates and the rise in shadow banking activities exposes the financial sector to increased risks. Macroprudential policy and monetary policy rely on separate tools and aiming to achieve different objectives. Yet they need to be coordinated, which is a non-trivial task given that financial and business cycles could be desynchronized. For these reasons, as I have already highlighted, macroprudential policy should also be under the responsibility of central banks. Finally, let me repeat the warning that without an effective macroprudential policy, advanced economies will not be able to ensure financial stability. It is therefore an important endeavor to keep fighting for the appropriate policies to smoothen the financial cycle and to sufficiently tame finance in order to avoid crises that threaten the future of our economies. Thank you for your attention.